Mode.
Hey everybody, Preston Brent here with our weekly roundup for the week ending May 26, 2017. First, I'd like to wish everybody a happy Memorial Day weekend for those of you that are in the U.S. For those of you that are offshore, Monday is going to be a big holiday in the United States. It's also going to be a bank holiday, I believe, in Great Britain and over in Germany. China, I think, will also be closed. So it's going to be a very quiet day on Monday. So hopefully all of you are enjoying this nice holiday weekend. Now, what I've got on the screen here is the E-mini S&P 500 futures on a daily chart. But I thought what I'd do this long holiday weekend, I'm going to keep this weekly update relatively brief, but I wanted to just take a step back and just kind of show you where we are and what the charts seem to be indicating to me. First thing I'm going to do is I'm going to clean up the chart, and I'm going to take us out to a weekly time frame. And now I've been talking about this with our members for some time, and it's basically plotting potential resistance points in what I call dry powder. You can see here on the screen on this weekly chart going back, and this does go back quite some time. That was the presidential election here this past November the 8th, the Trump bump, I think is what everybody calls it in the markets. And then you can see January and February time frame at the beginning of 2016. And then you can also see the highs that were made in 2015. And then, of course, this big downdraft right here was the August 21st Chinese yuan devaluation, which really rocketed volatility, the highest percent rate of ascension in the history of the markets. I think the VIX went from the low 12s to 52 in about 3 or 4 days. Just amazing. But be that as it may, what I've done here is draw a Fibonacci extension off of these lows that were made, clearly well-defined lows that were made in February 2016 and the previous 2015 highs. So that defined a range. And then from this range, I built the Fibonacci extensions, as you can see on the right-hand side of the screen here. And what I told our members is that this level right here, the roughly 2135 area, is the primary area that it took over, I think, what, 300, 400 days to break out again after we made all-time highs. It set records for not being able to take out that all-time high. And then when it finally did, back over here in 2016, towards the end of the year, remember that these were highs made in 2015, we finally took them out and we moved up. So all of this, before this takeout right here, there was no volume. And you can see this volume over price right here. There was none of it. So when you're plotting where can the markets go in dry powder, meaning we've never been there before, Fibonacci is a great tool because it measures fear and greed. It measures where human nature has a tendency to take profits, when buyers tend to step in, when sellers tend to step in, you know, because there's a constant battle in the markets between buyers and sellers. And it does a really good job of giving you a good framework for where you can expect support and resistance. Now, looking at this, we finally took out the highs right here back last year in late summer of 2016. And then we didn't get very far and we took it out. And then obviously right in this area here, this was leading up to the presidential election last year. And we had the lows, and then boom, we got the Trump bump. And then, you know, we've just come up and then we took out new highs here again. The markets, I think we've hit in 2017 alone 20 all-time highs from, and it's really amazing. Since the point that we made this all-time high here in 2015 to the point here where we took it out, took over 400 days. Right? It took over 400 plus trading days to actually make a new all-time high print. And then once we took that out right here, right before the presidential election in August, going into September, October, then November election right here last year. And then coming in, starting in 2017, which is right there, just in this area alone, we've made 20 all-time highs. So over 20 here, and then just one here, right? So we've just got a tremendous amount of buyers willing to step in and bet on the take, bet on the stimulus, the less regulation, the more tax cuts, a number of repatriation of money, corporate earnings, and also on top of all this, we have a Goldilocks scenario. We've got very low interest rates, all right? The 10-year treasury yields are very, very low. The yield curve shows that inflation is nowhere to be found right now, which is the difference between the 10-year and the 2-year. And we've got the Feds who are talking about doing a rate hike at their next meeting, which is going to be June 13th and 14th. And there's about an 85% chance they're going to hike the rates coming up. And then there's another chance of a rate hike in December. So all of this with low inflation, right? And interest rates, even with a 25 basis point rate hike, is still low, and corporate profit strong. So you've got the makings for this continued grind higher move. And you can see where we spent time at this fib level right here, and we spent, remember this is a weekly chart, we spent over 3 weeks here. And then it just seems like since February, we've been in this range right here. It's a wider range, but we've been in it since February to the grind, to the upside. Okay, so that's kind of where we're sitting now. But now with this fast move higher on this weekly chart, one of the things that I'm seeing is the breadth of market, meaning those stocks that are participating in this up move versus those stocks that are not participating in the up move. The breadth is not as strong as I would like to see, meaning it gets the further higher we go on less and less of the stocks, the more weak the up move or the advance will become. And we've got right now, if you take some of the large stocks that account for some of the biggest valuations in the S&P, like Apple, Facebook, Amazon, Microsoft, Google, if you take those, according to some analysts, they've accounted for more than half of the year-to-date gain in the S&P 500. In fact, they've accounted for almost 60% of the gains in the S&P 500. Now we're up this year so far about 7.89%, which would make almost 4.7% of that gain, of the 4.7 of the 7.9, is attributable just to those 4 stocks, 5 stocks: Apple, Facebook, Amazon, Microsoft, and Google. So the tech sector, the other thing that I'm seeing here is that the tech sector makes up a stronger percentage of the S&P that it's done than it has before, right? I mean, it's over 23-24% of the S&P. The historical average of the percentage of the S&P based on valuations and how they figure the S&P, the historical average is about 15.4. But right now the techs of the S&P make up 23.1%, and that's a huge percentage of the entire S&P. So the S&P is being driven to a large degree on these tech earnings. And as we all know, nothing goes straight up forever, and we're going to run into some strong overhead resistance. I did point out here that the next stop up is around the 2468 area. Let's call it 2470 roughly. And I do believe that 2341 is going to serve as a little bit of a downside support for us, because you can see here where it kept us tied up here for over 3 or 4 months. So we've got, and by the way, the other thing that I talked about last week was that from this here to this here, there is no and this is a weekly chart from there to there. There is no bearish divergence. I said any dip is going to be bought, and sure enough, that's exactly what we've done. And now we're pointing back up again. There's the zero line. We've crossed above it. So it does suggest we've got some more oomph to the upside. Next week, again, Monday, it's going to be a short holiday week, so we kick it off on Tuesday, but we've got a lot of the U.S. Fed presidents coming out, or governors, that are president of their region, coming out here in the United States and talking, and every one of them are going to be talking about raising rates. It's time, and also reducing the 4.5 trillion balance sheet. So again, it's going to be real interesting to see. The markets want to move higher. You've got strong earnings. Valuations are rich, but they're not overly so. You've got low interest rates. I think all eyes are going to be on the June 13, 14 meeting with the Feds. And what are they going to say? And where does money want to go? The other thing is, I had said last week, is the Trump bump going to turn into the Trump slump? And right now at this time, I don't see it. I do see some weakness in the markets coming up, but I don't see at this point in time, as I've been saying almost the entire year, we're in a buy the dip kind of mode. If I come back to the daily chart, and let me just stretch it out just a little bit, leaving the Fibonacci extensions as I showed you on the chart, you can see here where we've got a high pivot here and then a higher pivot here. But we've got the classic 3, 4, 5 pattern. Elliott wave, and with a 3, 4, 5 pattern, you typically follow the 5 leg with an ABC pattern, right? And then depending on where the pivot points are defined in ABC is going to determine, you know, are we going to continue in a chop mode, or are we going to continue to grind higher, or are we going to pull back a little bit more? On the near-term basis, and we also have a little bit of a divergence setting up here as well, which to me suggests a little bit of a pullback. I think, of course, the first logical pullback would be the psychological barrier of 2,400. Remember, we were sitting here for quite some time. We poked our head up above, and then when we really moved up, we moved up dramatically because there were a lot of people short the market here, and they were short down here, right? And to put a stop on your short order, you do it as a buy. So there was probably some short covering here as well. There's still a lot of people short the market. So the issue is how much pain are they going to be willing to take? I do believe that once we pump up, we can move back. Again, the 2,400 is a nice logical area that we could find resistance at, or support at rather. If I put everything on my screen, you can see we're at the all-time highs, 2417.75. And we're just south of the 2468, which would be the next fib node that would serve as a little bit more tougher support. You can see on the daily chart here, these fib nodes are sitting basically right on key levels here. And you can see we've come down and we spent a lot of time at these key levels. This one right here, the 50% node, again, you can see right in that area there. And then we've got the 0.38 node, where you've got a lot of volume and a lot of support there as well. You can see right here there is a wide swash of volume over price right in that area there. It's very wide. And then you've got these little, you know, acceleration points like this where buyers and sellers are duking it out. And then there's very little volume up here, which is holding us up right here. So I do believe the odds favor a little bit of a drift and then catch its wind. Again, you can see the divergence here on that chart. If we look at volume, just to get an idea, you can see volume right here. If I were to just kind of, let's box it in here, just like this. So you can see we had huge amounts of volume on that bar there and this bar right here. A lot of buyers came in. And then as we started taking out these other highs here and getting back up near 2,400, volume fell down. And then on Friday, which you would think would be a quiet day, we had a little bit more volume coming in. I suspect there were some sellers in this volume, even though we finished up, which is why it gives me a green bar print here. I suspect it was people basically taking some profits for the week. But basically volume did just fall off the table as we started this move up. Again, I think the markets are going to be in a grind mode. I think any downward draft here is going to be basically an argument for buy the dip. I don't see that changing near term. I don't see anything on the horizon short of any kind of geopolitical event. Or any kind of thing that is unanticipated right now coming up that could really, take the market and move us down dramatically. The key pivot is still located right here at 23.17. That is a very key pivot. And we got some minor pivots as we're making higher lows as we move forward in time. But to me, the key pivot is still going to be this guy right here. Okay, so that's what I'm going to be watching for as we're running our trades. Now, the other thing I will show you is if you look at the Russell, which is small cap, it's basically driven by companies that have more of a U.S. presence. You can see here the small cap is a lot weaker than the E-mini S&P 500. I mean, you can see here we actually went into the red for the year with some of that sell-off last May 20th, that big 1.8% downdraft. We actually went into the red for the Russell. And we're not that far away from the opening price of the Russell. So we still have some underlying weakness here, as I said earlier, that we've got to watch very closely on. Then, of course, the Nasdaq, which is made up of those stocks I had talked about, Apple, Facebook, Amazon, Microsoft, Google. We made a new all-time high on Friday. It just will not stop. It will stop, folks. It's just not ready yet. We're setting up for a near-term bearish divergence on the daily, which to me makes sense to come in here and look at possible shorts in Nasdaq. Remember that 1.8% move in the S&P last Wednesday. Nasdaq was further down than that. It fell 125 points in one day. Big move. I think it's setting himself up for another move to the downside, which would be not a change in trend, just more of a profit-taking kind of thing, although it can be quite aggressive, quite ugly. In fact, on this daily chart, you can't even see, that bar doesn't even really stand out that much. It's this bar right here, right? And then, the momentum carried a little bit lower the next day, but outside of that, it just shot right back up again. So I think we can expect some support here, but I think over the next 30 to 60 days, and more people are getting short. The short interest in the S&P is going higher and higher, which is why the markets seem to be just moving a little bit higher here until I don't see a lot of capitulation in the market yet. But I do believe we're still in this grind mode. We're still in a buy the dip mode. The other thing I wanted to show you guys, look at volatility. We're back down to where we were before. Vol finished at 9.81 Friday. I mean, folks, we're down near these lows here that we made last May 9th. And these lows right here, well, let me just put it back on the low right there. Let's just go that. We're in zone 1, which is this green zone for option trading strategies that tend to make more sense here on the overall indexes. You can see here we finished, like I said, 9.81, and the low was 9.56 that we haven't seen in over a decade. So we've got to be very careful here, and it can move very quickly. So right now the markets are fairly complacent. The other thing that I wanted to show you here is even with all of this strong up move, money is still going into bonds. Bonds finished up on Friday. And if you look at this chart here, you can see here the big down day on Wednesday of last week was this bar right here. You can see money just poured into bonds. From this level right here, we had that big breakout. Right here, and money poured in. And then after that big down move, that big reversal in price, well, bonds hadn't moved anywhere. It stayed almost here in this range, right in this area here. Bonds did not sell off again. Money is staying in the bond market. the only thing that's going to get bonds to move down is a little bit more belief in this bullish market. Otherwise, you're going to keep this larger percentage of money in the debt market. So there's still underlying fear in the market, and you wouldn't see it by the put ratio, the put call ratio spread, or the volatility. But there is issues in the market. Now, there's some other things that we're doing in currencies. I told you guys I'm more bullish the euro, more bullish European equities. I am US. You can see the euro is just off to the races here. I'm not chasing it up at this level. We've played some bullish trades in the euro already. I see more coming. You can see the US dollar here is doing just the opposite. It's moving lower. Logic would seem to indicate the dollar should be going higher, but it's not. We follow price action. That's what it's showing here for the US dollar. As I've been saying now all year, any up move in the dollar is a sell the rally kind of event versus buy the dip in the equity markets. And then of course in gold finished Friday real strong, up 10.3. I want to see it really clear this area here, get up above 1270 before I become a bigger believer in gold. Silver had a bigger downdraft. It's moving up a little bit too. You can see it's sandwiched between the 50 and the 200. I want to watch this closely as well. And then of course there's oil. We've had 5, I think maybe 6 trades in a row where we've had successful trades in oil. We put another one on that looks like it's going to be successful early next week when we take our profits again. We're playing the oil markets here. You can see I'm not a big believer in any up move in oil. I do believe that we could grind a little bit higher next week. Taking advantage of that. We're taking advantage of that with some trades in the oil market. There's other things going on in softs, in the meats, and in the ag market. We're making some interesting looks there. And we've got, of course, our foundational anchor trades in the SPX index. We're looking at putting some more on in the Russell. So for those of you following along, we will not have our session this Sunday night. It'll be a holiday for us. If you're not in our group, I've got some Memorial Day specials you might want to take advantage of. We're getting more and more folks out there. Also, for those of you in the Asia Pacific area, I will be in Singapore. I'm looking at setting up a seminar there, either in the March-April time frame or late summer, early fall. Not really sure where or when I'm going to be positioning in that, but that's what I'm looking at right now. Otherwise, everybody, I will also be spending a couple of months this year, as I always do, in Europe. So I'm going to be bouncing around a bit, but this is kind of where we're sitting right now on this Memorial Day weekend. Everybody have a great time. Enjoy the burgers, beer, and fries, or whatever you do with friends and family. I will be doing all of the above. Have a great one, everybody. I will see you and talk to you next week. Thanks. Ciao.